Good morning all and welcome to today's video. So today I have just the one pair on watch, and that is Kiwi dollar. There was actually an entry that I could have taken on Swiss yen yesterday. If you remember, if you've been watching my videos, you will remember that I was looking at Swiss yen. I didn't take that entry, and what I wanted to do is I wanted to touch on why I didn't take that entry. And it was for one specific reason, which has been a factor in a lot of my losses historically. So I'm going to touch on that now, why I didn't take this entry. So on the higher time frames, I'm just going to run through this very, very quickly. So on the higher time frames, you can see that we were just moving up for a long period of time. There was no real structure for us to work with. Those of us who trade the Falcon strategy trade market structure. The structures that we look for are indicative of psychological patterns that have repeated themselves for decades and decades and decades, and they are loosely based on Elliott wave theory, which has proven consistent since, from memory, the 1860s, but that's another story for another day. But anyway, if we drill out to the daily chart, the reason that I was looking at this pair is because we can see here that we have this impulse correction continuation, which breaks above an all-time high. Okay, we know that at all-time highs or on higher at the higher time frame liquidity points in general, what typically happens is that people who believe in particular that resistance becomes support once it's broken above, they start buying, and what we see in the majority of cases is price plummet to the downside, and you can see that we saw some evidence of that yesterday. The other factors were that the continuation leg out of an impulse correction continuation tends to be of a similar length to the preceding impulse. So if we look at that there, we have an impulse correction continuation. We've kind of fulfilled that move now, and we have a series of near misses. We have a near miss to there, a near miss to, and a near miss to there. Okay, giving me a clue that there is still liquidity. So this one here, if we don't quite tap into an area of liquidity, that means that the liquidity is likely still there and needs to be filled before price can do anything else. And likely that because there is liquidity still there, it will drag price down. Okay, so that was the thesis behind this trade setup. We then, if we drill down, we had this, you can see we had this kind of corrective wave coming down. Okay, that doesn't surprise me because I've often likened these higher time frame liquidity points, particularly these all-time highs, as train stations. Okay, so if you think of this as like King's Cross Station, Paddington Station here in Scotland, Edinburgh Waverley, you typically see more people get on or off of the train at train stations which are bigger train stations, if you like. So an all-time high is a bigger area of liquidity, a more significant area of liquidity where more people are likely to get on or off. So with that in mind, it's not normally the case that we just get to these areas of value and then price just moves immediately. There are typically lots of people that are trying to get on or off before price will move in one direction or the other, and in most cases to the downside. So it doesn't surprise me that we had this kind of corrective move down before price actually dropped out of this corrective wave. Okay, so we have corrective wave, then we have an impulse down followed by this correction. And what if I had have taken this, how I would have taken it would have been as follows. So this is a 1 hour structure. Okay, this is a structure which I can see on the 1 hour chart. And what I would have done is I would have waited, these are my rules, I would have waited for this 1 hour candle, this green one, to close at the area of value. I'm not put off by the impulsiveness of this 1 hour candle. Typically speaking, we do see impulsiveness at the end, at the last part of a move, if people are getting out of their positions for the move to the downside. So I would have waited for this candle to close, and then I would have dropped down to the 15-minute chart to look for entries. Okay. So we kind of have that impulse correction continuation. We have an impulse correction continuation middle section within that. So that's a tick in the box. So when this candle closed, this green one at 1 p.m., I would have dropped down to the 15-minute chart. And you can see this red candle here. My rules are that it has to be a retrace or a pin bar candle. So we get the retrace candle there, that red one there. I would have set a market order. I would have got in and I would have had my stop loss just above there, and you can see that price would have dropped. We also have this kind of 1, 2, 3 last leg here. We have that kind of 1, 2, 3 last leg. That's a tick in the box. There's one very specific reason why I didn't take this entry. Normally, one negative confluence factor wouldn't put me off of the trade. However, this is where documentation comes in, okay? If we just drill out to the 4-hour chart, the previous the previous 4-hour candle to close just prior to me getting short was this green one here. Okay, see this green candle here. Now, even this impulsive momentum of this green candle, this green 4-hour candle, doesn't put me off. However, when we have a green candle, a bullish green candle like that on the 4-hour chart with a big wick beneath it, there are 0 examples in my trading documentation of when I've placed a trade and the previous 4-hour candle has closed like this. There are 0 examples of me placing a winning trade when the previous 4-hour candle has closed like this. So that is why I stayed out of the trade. Okay, so there's being a perfectionist and staying out of a trade because of one negative confluence factor or 1 or 2 confluence factors, but not all confluence factors hold the same weight. Okay, some are more important than others. Okay, and so when I know that the thing that has been most prevalent historically in my losses has been when I've tried to get short after a 4-hour candle which is closed like this, that is enough to keep me out of the trade because it is a significant confluence factor as opposed to an insignificant one. Okay, we also have the factor that, so then the next question I ask myself is, well, what does that mean? Why is that significant? Well, what typically happens is if we have a 4-hour candle which closes like this, price will move sideways before it drops. So the next question I ask myself is, what reason does price have to move sideways? Well, if we just kind of measure the impulse, okay, using the Fibonacci tool, if we assume it kind of comes from here, that is kind of, well, we do have a bit of a 30% retrace, okay, but typically speaking, well, if we take it from the break, we do have it. That is a healthy enough pullback, but the thing is that is still quite a heavy drop, and it wouldn't surprise me, particularly you have to know the pair that you're trading. On a pair like Swiss yen, it wouldn't have surprised me if price had have moved sideways. We'd have had another middle section and something like that before the drop. So the next question I ask myself is, what reason would price have to do that? Well, one, it would be more of a healthy pullback. And also, if you just look at the consolidation to the left, that would be a little bit more proportionate. That would be a bit more, with the market is often giving us symmetry. Okay, so if we got something like that, then that would be a bit more symmetrical to what has occurred to the left versus this slightly smaller flag. These are kind of insignificant things, well, kind of small things, but they all stack up. We're building the picture. And so when price sold off like this is another important point. Okay, so we had that 4-hour candle. We kind of have a bit more of a correction to the left. Not really too concerned about that, and it wouldn't surprise me on a pair like Swiss yen if after a big move down like that we consolidated sideways for a little bit longer before the drop. So when price did drop, so after the entry that I would have taken, when price drops, here's another little a key little lesson. When price drops with one candle like that, normally if we're going to impulse to the downside, we would do so not correctively, but with a kind of more of a series of candles like that. When we just drop with one seriously bearish 1-hour candle, often these bearish candles can retrace just as quick as they came down. So that is another reason. Obviously, this was after the potential entry. That is another reason why I anticipated price moving back up. When we just literally drop in one 1-hour candle like that, after the previous 4-hour candle has closed like that. Obviously, by this point, we did have a 4-hour candle like that. But even so, often these very bearish 4-hour candles like that can retrace just as quickly. But when I saw in particular this 1-hour candle just drop like that, once you've seen enough price action, you just get a feel for things. And typically speaking, these can retrace just as quickly, and it did. Okay, so in this instance, this is not something we typically do, but if I had have taken this trade in this instance, I would have actually been able to make some profit. I would have had my stop loss. So what's that? 17. I would have had that at, if we just call that 20. Whoops, I put the wrong thing in there. I can't see because the microphone's in the way. Right, I would have had my stop loss like that. Okay, and I would have then been managing this on the 1 hour chart. I would have probably, what I would have done here, because I would have locked in about half of this move. So when we closed down here, I would have locked in about half of that, had my stop loss about there. That would have given price just enough room to retest the low if it was going to correct sideways and then drop. So if we'd have just corrected sideways underneath here and then dropped, that would have given it room to breathe. And then I would have kind of locked in just above the flag if we'd have dropped. So I would have actually walked away with some profit from this one. But this is another important lesson. You might think, oh, well, you could have taken that. You could have made some profit. It's not about what happened on a one-off cherry-picked example, cherry-picked scenario. We're risk managers at the end of the day. And to manage risk, we need to think probabilistically, okay? We need to think with a probabilistic edge. What gives me a probabilistic edge? And my trading trading documentation has shown me that that entry does not give me a probabilistic edge because of the reasons given. Okay, so just because it played out on one example, that is not a reason to take the trade. What is a reason to take a trade is because the setup has played out in the majority of examples. Okay, over a large sample size of trades, an entry setup has given you an edge over the market. Okay, that is the reason to take the trade, not just because on this one example it played out. But anyway, that's the thought process behind that. And you can see price has broken some distance above here now. I've talked about on the higher time frames, we typically break above before breaking back in. But on the lower time frames, so when we have lower time frame structure like this, it's not typically the case that we move this far from the area of value, which would be here, if we're going to move to the downside. So that gives me a clue that perhaps we're coming back up to test these highs again. Swiss yen has been moving to the upside for a long period of time, but rather than guess what price is going to do now, I'm not going to, try and guess. I'm not going to try and guess. I'm going to let the market show its hand. So typically speaking, we don't move that far from an area of value if we're going to move to the downside on the lower time frames. So this doesn't fill me with confidence that a trade to the downside would play out now. So I'm just going to leave it alone. And that is one of the things that traders can't do. They just can't leave trade setups alone when they do something other than what they were anticipating. But I can. Okay, so that's what I'm getting very good at, is leaving things alone when price has done something different. So the only pair that I haven't watched today is Kiwi dollar, and the reason being is, if you've been watching my videos previously, you will know why I'm looking at this. But the reason I'm looking at this is because we tap into this sharp area of liquidity. Okay, we have a sharp move up followed by a sharp move down. That gives me a clue that this is a high area of value for a sell. The sharpness of a particular liquidity point often indicates how aggressively price will move from that area next time around. In this instance, it didn't really do that. However, it's still an area of value. We have the near miss up there, which I said was a slight negative confidence factor. However, I'm not bothered about that, because we are clearly in a run of momentum to the downside. Crucially, we have corrected below this low, giving me a clue that there was not enough liquidity at this low to send price to the upside to potentially take out this near miss to here. And instead, we corrected below this low. And you'll see that more clearly on the lower time frames, which gives me an indication that we're going to take out this near miss to here, which price failed to tap into last time around. So just looking for that impulse correction continuation to take out this low, which we near missed to last time around, where the liquidity is likely sat, where the bigger players will likely be getting out of their positions. I'm always asking myself, where are the bigger players likely to get out of their positions? If this is moving to the downside, they're likely to get out either here, and if we've near missed this area, likely here as well. Okay, so we then have, if I just drill down, I've touched on this previously, if we just pattern separate this, we have this bullish green wick. These often get filled. We come back up, we fill that wick, we push down, then we have this expanding pattern here. We have this 1, 2, 3. We have a bullish wick here, which gets filled. Okay, then we have the middle section, 1, 2, 3, middle section, a 1, 2, 3 last leg, where the impulses within this impulse correction continuation are of a similar length. We break just above, stop everybody out, tag all the limit orders that were likely set in that area as well, and then we push down aggressively. We then have the same thing here. However, in this instance, you can see we have this 1, 2, 3. We have a middle section there as well. In this instance, we have a scoop double top. Sometimes price comes up. If it comes back up, if there's still orders sat above there, it breaks just above, stops everybody out, tags all the limit orders, and then pushes down aggressively. And then, as I said, crucially corrects below this low. Then if I just drill down to the 1 hour chart and get rid of the paintbrush tool, we have, what do we have? We have a sharp hook point. Okay, we have a sharp hook point there. Price scoops back up, near misses to that area, giving me a clue that the liquidity is likely still sat there. We come back up again, we near miss to that area again. We move down, come back up, we near miss this area and this area here, giving me a clue that we will likely need to tag this area, particularly when it kind of is a retest of the back end of the previous structure before price can move to the downside to take out that higher time frame near miss. We also have this 1 impulse correction continuation. The legs, if we just measure them there, would be of a similar length. Okay, if we just measure the impulse correction potential continuation, that lines up perfectly with there. We know they're often of a similar length. You can see that price has trickled sideways a little bit, and that gives me a clue that maybe we have to remain neutral on these things. Maybe price is doing something other than what we anticipated. However, you can also see here, if I just drill down to the 15-minute chart, you can see the same psychology. We have this low here. Okay, we near miss to that area. We move up. We have this middle section, 1, 2, 3 middle section within this expanding pattern. So where we have equal or lower lows and equal or higher highs. So we have higher highs and slightly lower lows. That's an expanding pattern. We have the middle section. Price taps into this area that it near missed to. This is the FOMO channel, as I like to call it. We tap into that and then we move to the upside. We've moved up quite correctively, which gives me an indication that this may not be ready by the end of the day. We may be seeing what I was talking about yesterday in yesterday morning's video. We may be seeing more of this kind of where we get a kind of slower move into that area, and we get that kind of 1, 2, 3. I've not really drawn that right, but I'm not really seeing that so much, because if the wider this correction gets, the wider this overall correction gets, the more likely it is that this becomes this correction becomes neutral and price breaks to the upside, which would kind of tie in with what the DXY is doing, because it kind of ties in with that. Okay, so the wider this correction gets, the more neutral and less likely this becomes to play out to the downside. But you can see we may be getting some momentum coming in. All I really need is for price to just tap into that area. These are just things that I'm factoring in. They're not things that necessarily put me off. They're just things that I'm factoring in the interest of being probabilistic and neutral. So we kind of have that impulse correction continuation within that impulse correction continuation or potential continuation, and then we have that impulse correction overextended middle section. So what I'll be looking for today is the same as yesterday. I'll be looking for price to tap into this area of value, push down and flag. As I said, partly because of the width of this now, I would not be looking to try and call the top. I'd not be looking for a risk entry here, particularly when we could trickle up to this trend line. And as I say, it's getting wider and wider, so I'm mindful of taking a risk entry. But if we tap into that area, push down and flag, and then I will look to get short on the break of the flag or within it. And that is it. That's all I'm going to be looking for today, folks. I hope you've enjoyed this video. I hope my little non-trade recap, if you like, on Swiss yen has helped you a little bit and given you my reasons for staying out. I don't stay out of a trade through fear or anything like that. Those days are long gone. But I do stay out of trades if there's a big red flag, which my documentation has told me that is a big reason to stay out of a trade. That is when I will stay out. And, as I said previously, lots of people are very good at getting into trades. But one of the reasons the failure rate in trading is so high is because people that are profitable, some of them, just do not know how to stay out of trades because they're trying to get rich quick, many of them, and their psychology is just not where it should be. But anyway, that's it, folks. I will be back most likely tomorrow with another video. Have a great day, and I will speak to you again soon. Thank you very much for watching.